Hello friends, this is Vijay Bambwani. I'm so glad to be back again after having recovered from being under the weather, and I'm really pleased to receive all your good wishes, your prayers for my speedy recovery, etc. I'm truly touched. I thank you all, and let's proceed in this video to take on the markets which are at an extremely critical juncture. And believe me, the thumbnail of this video is not clickbait. It is not to sensationalize the issue or to basically excite a feeling of nervousness or anticipation in the viewers, but a genuine case that I am going to discuss in this video. Friends, I promised you that I will reveal more and more in-house studies over a period of time in my videos, and I'm going to show you 4 more studies in this video which will basically support what I have written in the thumbnail. Now, last couple of weeks I have seen that it is the FIIs versus the Indian retail traders, actually FIIs and the professional traders versus the average retail trader. The retail trader, as it is known in boxing parlance, is standing toe to toe, face to face, opposite the professionals and FIIs on the other end. So go through this video till the very end and you'll see what I mean. Now, coming up on your screen is the market roundup, which basically tells you that the week ended with mild losses because the overhang of inflation, spiking bond yields, and the threat of rising interest rates unnerved the bulls. Now, these are issues that I have discussed in my earlier videos since the last 8 to 9 months, and hey, we've been far ahead of the market, and I promised you I would share my studies which would keep you far ahead of the general consensus. And here you go. These are issues that are becoming the talking point of the markets only now, and you've been hearing it since months here. Now, what we are basically seeing is that the bank Nifty has fallen faster and further than the Nifty. I've been warning you about the threat of rising inflation, oil prices, the dollar, and bond yields, and the impact on A, the banking stocks, and B, the bank Nifty. So even if you're just an equity trader, it makes sense to basically look out for all these signals. Do note that the bank Nifty has peaked out along with the Nifty 50 in the month of February, mid-Feb, and those peaks are still not being taken out. Now, as you can see on the market roundup screen, bullion also eased mildly because the US dollar index, also known as the Dixie, rose a bit. The USD INR, on the other hand, fell marginally, which makes the INR, which is the rupee, relatively stronger than the US dollar in the absolute near term. Now, it is this very factor that cushioned the declines in the market, which would have otherwise fallen far more significantly. Had the dollar been very strong, it would have been a bad week for the bulls. Bond yields also rose marginally, and that I will cover in greater detail in the bond segment. Now take a look at the MWPL, the Market Wide Position Limit chart on your screen. It shows a steady rise on a week-on-week basis because the retail traders continued to build up fresh exposure. Why am I so confident in saying that the retail traders have built up the long exposure? I'm going to lift the curtain of the 4 new studies, which I assure you will not be available anywhere else in the public domain. I challenge you to find this elsewhere. So, how do I know? Now, I'm going to share that with you. Watch the next 4 charts very carefully. The first one on your screen right now is the foreign investment institutions trades that they are actually executing day after day. What are they buying and what are they selling? Note how they've been selling stock futures throughout the week, and they've been selling index futures on most days of the week. Now on your screen is the second chart in which the FIIs open interest is shown here. Now this is the long minus short trades, and these are overnight trades which are remaining open at the end of the trading session. What you are very clearly seeing is that the FIIs have been maintaining net short positions in the index since the last 3 consecutive sessions, and the stock futures open interest is also falling consecutively for 5 trading sessions. Like I said, this information will not be available elsewhere in the public domain. But wait, this gets even better. Look at the third chart on your screen. This is the open interest of the professional traders and the prop trades, the proprietary trades of the brokerage firms. They remain net short on the index futures, and their longs on stock futures on the other hand are rising, which means that the professionals are preferring to hedge their longs by resorting to small sized shorts, but they have remained net short on the indices. Now take a look at the fourth chart, the final chart. Now this is the open interest of retail traders, people like you and me. Now here again, what you are seeing is that the open interest on the stock and index futures, both segments, are showing rising exposure levels, long exposure levels. What does it tell you? Does it ring a bell? Yes, it does. The professionals and the FIIs have been defensive. The retail traders are basically throwing caution to the winds and going all out, and they are buying. So, which is why I said the professionals and the retail traders are going toe to toe. They are facing off against each other. Stick around. In this video, I'm going to reveal a lot more and share many more such eye-opening studies even in our future videos. Now take a look at the basis chart. The futures premium on both the Nifty and the Bank Nifty fell on a week-on-week basis because selling at higher levels eroded the premium of futures over cash. This can also be seen in the call options premium. Had it not been for Friday's short covering, the basis would have been far, far lower than where it is now. And now let's take a look at the stock and index futures volumes chart. I need to draw your attention to the fact that these are volumes of all 3 series cumulative, which is May, June and July. The turnover was higher on a week-on-week basis in both segments, which means the declines in prices saw active participation from the sellers. And now let's take a look at the impetus chart of the Nifty and the Bank Nifty. Now the impetus is nothing but statistical momentum or velocity, which in both cases is slowing down on a 20-day look back period. The indices are displaying smaller swings, and off late they are basically showing a narrowing down of the ranges, which means that they are probably preparing for a much bigger move in the coming few weeks when volatility might just shoot through the roof. That said, let's now go to the 10-year benchmark bond yields, the crux of where the money comes from. Now, this is a segment that I frankly feel I have drawn your attention amongst the first people in the YouTubers to basically correlate bond yields with the Bank Nifty and the banking stocks. So stay ahead of the curve. Note everything that basically impacts the price of whatever you trade, and this is what we call a 360-degree worldview. The bond yields are now gearing up for the Government Securities Acquisition Program, or GSAP, the second version of which kicks off on Thursday, which is 20th of May 2021, for a total value of rupees 25,000 crores. I had told you over a month ago that the RBI may wind up resorting to GSAPs as many as 4 times a year. And here you go, even though I've been absent for 3 weeks or so from YouTube, you already have GSAP Part 2 being announced. Now, you shouldn't ignore the bond markets even if you're just a pure equities trader, because the bond market is where the money supply comes from. The RBI will try to push down yields through the GSAP so that it can borrow its targeted 12 lakh crores from the bond markets at lower rates in this financial year itself. Which is why it becomes super critical for banking stocks and bank Nifty traders to watch this GSAP on Thursday, which is 20th of May. I promise to keep you updated in the forthcoming videos about this GSAP and how it impacts your trades, especially on the banking stocks and the bank Nifty. So for now, I would only say that in the coming week, trade the bank Nifty very cautiously. Friends, let's now go to the US dollar index, which is the currency benchmark of the United States dollar vis-a-vis the global basket of currency. This firmed up slightly on a week-on-week basis, and that was responsible for pushing down bullion and base metal prices, along with threats of rising interest rates in the US. Now, the daily chart on your screen shows the price staying below its 25-day exponential moving average, which itself is sloping lower. Now, unless the price closes sustainably above the 91.50, 91.5 mark, the bulls are likely to remain on the back foot. Any renewed talk of rising interest rates in the United States will see fresh bouts of volatility, probably on the upside. So keep your ears to the ground and monitor the news flow. The weekly chart, on the other hand, coming up on your screen, shows 6 weeks of lower tops and lower bottom formations. And here too, the 91.5 mark is a hurdle to watch out for on the upside. For the coming week, I expect the estimated, I emphasize on the word estimated, range for the next week is 91.40 on the upside and 89.25 or 89.25 on the downside. Friends, the US dollar index done. Let's now go to the bank Nifty, the second most liquid counter on the NSE FNO segment. This banking benchmark index fell on 3 out of 4 trading sessions last week and underperformed the Nifty. Note on the daily chart on your screen how the price remained below its 25-day exponential moving average and is making lower tops since it peaked out in the middle of February. We would need at least one higher high before the bulls can get a sustainable advantage all over again, which means I'm essentially looking at a breakout and a sustained closing above the 34,500 mark on a continuous closing basis before I think that the bulls might just get some relief. On the other hand, the flip side, a sustained trade below 30,500 opens up the potential downside. Now, do note on the weekly chart on your screen, this pattern is called a bearish engulfing pattern, where the last red candle's body completely dominates the previous bullish candle's body. The price remains above the 25-week exponential moving average, which means the immediate outlook has not yet turned outright bearish. But if the weekly low of the previous candle, which is a bearish engulfing pattern, is violated on a sustained trading basis, the bulls can be in trouble. So do watch that weekly low very, very carefully. If the index takes support on the 25-week exponential moving average and bounces higher, the bulls might just get another chance to fight back. Now, the week before last, the index was number 3 on the most volatile list, but last week it fell sharply to number 5 because stocks got more volatile, and like I mentioned earlier, the indices basically saw contraction in the daily ranges, which is why volatility actually went down on the headline indices. The coming week is likely to see some anxiety, especially because Thursday holds the GSAP, or the Government Securities Acquisition Program, on 20th of May. And the anticipated or expected range, I repeat the word expected or estimated range, is likely to be between 33,925 on the upside and 30,400 on the downside. I remind you, my friends, trade light on the Bank Nifty because you're likely to see a news-based trigger on the bond buying program. Friends, let's now go to the Nifty 50, the most liquid counter and the lowest impact cost counter on the NSE FNO space. This index also fell on 3 out of 4 trading sessions, like the daily chart shows on your screen. The price is resting at its 25-day exponential moving average. Note how this index chart is appearing relatively flat as compared to the Bank Nifty. Now the Bank Nifty is unmistakably falling, which is why the Bank Nifty is relatively weaker than the Nifty 50. By now you know the reasons why the Bank Nifty is under pressure. It's the usual suspects: bond yields, inflation, dollar index, and oil and gas prices. Now here again, the peak made in mid-February remains inviolated, and if you were to add the cost of carry for 3 months, which is Feb to March, March to April, April to May, that means that the bulls are at a slight disadvantage, but it's not as bad as the Bank Nifty, of course. A breakout and a continuous close above the 15,000 to 15,100 mark can actually change the sentiments around completely and would favor the bulls in that case. On the flip side, if the markets were to fall and trade sustainably below the 14,300 mark, give or take a few points here and there, it can lead to more falls and a disadvantage for the bulls. What is immediately obvious is that the daily ranges of this index are shrinking, like I mentioned even for the Bank Nifty, which makes it like a compressed spring. Which means it can expand suddenly without any advance warning. Now this hypothesis is also borne by the fact that the week before last, this index was number 9 on the most volatile list, but last week it fell to number 13. Now that's a big fall. Now if you were to check out the weekly chart right now on your screen, you'll see that the index still remains above its 25-week exponential moving average, which means that the near-term outlook still hasn't gone totally against the bears as yet. The short-term channel on this chart may prove to be a flag formation if and only if the 15,300 level is overcome sustainably. In that case, like I said, the bulls will come back in the driver's seat. In the coming week, I expect an estimated, I stress upon the word estimated, range between 15,200 on the upside and 14,150 on the downside. Friends, the indices done. I now come to the most popular segment of this video, wherein I give you 5 stocks that are high beta, high impetus, where you take small exposure, wait for bigger price swings, and 5 stocks that are low beta, low impetus, where you take big exposure, wait for small price swings to make your money. Now, high beta, high impetus stocks list is led by Godrej Consumer Products at number 1, number 2 being NTPC, number 3 Rural Electrification Corporation, number 4 Berger Paints, number 5 Colgate. The low beta, low impetus stocks list is led by UBL at number 1, Bajaj Finserv at number 2, Bajaj Finance at number 3, AU Bank at number 4, and TVS Motors at number 5. Friends, before we wrap up this video, if you do like this video, subscribe to my YouTube channel, click on the bell icon to receive instant updates about fresh videos being put up out here. I would love to hear from you in the comment section. Do let me know what you think of this video. And do also note that I have an associationship with equitymaster.com, whose playlist I have enclosed in the description below this video in the description segment. Do check out more videos from me at equitymaster.com, and also let me know what you think of those videos as well. I wish you stay safe, take care of your friends, family, your trades and investments. Vijay Bambwani signing off for now. Thank you for your patience. Do connect with me on my social media accounts. We can have conversations going and discuss markets, and where I put in daily data post-market. Feel free to connect. Here are my contact coordinates on your screen coming up right now. I would love to hear from you. Thank you for your patience. I wish you a very, very profitable week ahead. Vijay Bambwani signing off for now. Take care. Bye-bye.